Hello, everyone, and welcome to today's NinjaTrader Ecosystem event, Day Trading Market and Volume Profile Secrets. My name is Patrick Hodges, and I am a NinjaTrader Ecosystem Vendor Relations Representative. Before we start today, I do have a few housekeeping notes for everyone in the room. Webinar is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. Any brokerage-related questions should be directed to the NinjaTrader brokerage using the phone number or the email that you see on the screen. I'll also enter those into the room as well. Lastly, if you are new to NinjaTrader, please make sure to sign up for a free NinjaTrader account, which includes access to 14 days of complimentary real-time market data. Our platform is always free for advanced charting, strategy backtesting, and trade simulation. You can create your free account by following the link that's entered in the room, or you can find it there on the screen as well. Make sure once you get to that screen, you go ahead and click the Get Started option under the Welcome section. All right, now before I turn the mic over to Rob, it's important to understand that futures, foreign currency, and options trading contain substantial risk and is not suitable for every investor. It is possible to lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. For more information or for a copy of the full CFTC risk disclosure, please visit the link I'm entering into the room. Also, please remember that these training sessions are not a solicitation nor a recommendation, but simply educational in nature. Once again, I want to thank everybody for joining us here today. And without further ado, it's my pleasure to welcome to the NinjaTrader webinar room, Rob Mitchell. Go ahead and take it away.
Thanks, Patrick. Thanks for the introduction. Hi, guys. My name is Rob Mitchell, and today we're going to be covering some things about market profile that I've learned over the years. It's interesting that the very first webinar I ever did was on market profile, and I decided we'd come back and revisit that many years later, probably 15 years or longer since I did that. And I've learned a lot along the way. And so today's webinar is just about me sharing some of that with you, showing you different ways to benefit from market profile. I know Patrick already covered this, but past performance not necessarily indicative of future results. There's a risk of loss trading futures. Don't use the grocery money for trading. Yeah. So as I said, we'll be exploring some market profile concepts in general and various different permutations of it as a general trading technology, strengths and weaknesses, and share what I've learned over the years. So market profile actually began back in the 80s. A guy named Peter Stedelmeyer at the Chicago Board of Trade took essentially if you ever took like a statistics 101 class, a standard deviation, but turned it sideways and stuck it on the chart. And we'll be looking at some market profile charts as we go forward here. And so it really wasn't anything any more than that. And he showed it to the Board of Trade, and then they actually got a patent on it. And you had to pay to be able to use it. And then that didn't really grow that way. But once they released it and made it commonly available that people could do it, different vendors started making software for it. We developed software for it, and everybody's got their little angle on it. And I'm going to discuss that a little bit, which forms of it might, be ones, but, some of the different ones that you might see, market profile, volume profile, and different kinds of moving profiles or ladders all kind of evolved out of that. And so we'll take a look at some of those things. At the core of market profile is this thing called auction market theory. And
Rob,
yes?
I hate to interrupt you. I apologize. It is still showing my screen, by the way.
Oh, well, shoot. We can fix that. Thank you, sir.
No problem.
Which screen? We should be on screen 5. And then I'm going to just back this guy right back over to where we were. Yeah, so we'll just be exploring market profiles of general trading technology. And then this is my first slide here. So hopefully everybody can see, or even that. I think we've got it now. Yeah, so, okay, so market profile, where it came from, starting with Pete Stettlemyer at the Chicago Board of Trade, and then the various different forms of market profile, volume profile, moving profiles, and ladders. Now, under this general heading of auction market theory is the people that came after, like Dalton and other authors who wrote about auction market theory and the use of this kind of a technology on charts. And there are many different concepts and ideas that are not just usable for market profile, but that if you take the idea that's behind it, you can extend those same kind of thinking to other areas of trading, which is a super fascinating subject unto itself. Because this thing, having been at the Board of Trade, actually attracted a lot of really smart people who kind of turned that into, as I'd used the term earlier, a technology, auction market theory. And so a lot of the concepts and things that I later evolved towards what we call market mapping have their root in these ideas about auction market theory. One of the first things about auction market theory that I learned was the idea that, and we'll cover this in a little bit of detail, I'll show you how that works. Initial balance period multiples. So you essentially look at the first hour of trading or the first hour and a half of trading, and you ask yourself things like, how far does it go from that? So you use that first hour as a basis for which to project on a relative basis what the range for the rest of the day will be. And actually, the core of this kind of thinking is actually fundamental to mapping out markets and making predictions in markets. And it was actually these guys that developed a lot of these things. But I'll cover that in a little bit more detail as we go. Now, originally, market profile was done on 30-minute charts, and I've seen people using market profile on different charts. And there are ways to do a market profile and project it onto a chart that's not a 30-minute chart by using the 30-minute data in your NinjaTrader. Our version of it certainly does that. But auction market theory and market profile is fundamentally a 30-minute tool. Yeah, it's 30-minute. And for that reason, this interval of time, 30-minute charts, become a dominant interval, because the following for market profile in that time following when Stettlemyer first created this and the Chicago Board of Trade promoting it, actually started taking a foothold to where a huge number of people were doing market profiling, but particularly so in a 30-minute interval and using time, what's called time at price, TPO. And so that is the most fundamental way of doing what is actually called market profile. And then later on, different people came in and said, well, we could do this with volume. Instead of using time at price, we could use volume at price. They're usually pretty similar. And then doing things where the profile wasn't fixed to any 30-minute period. And then later on, putting profiles on like every single bar on your chart and have like 40,000 different numbers all over your charts. Yeah. And so, but for this reason, because this whole thing started with these 30-minute periods, the 30-minute period becomes a super important time frame, if you will, or interval to watch. And almost everything that we do, like in our mapping, in some way relates to that. By the way, on this webinar here, I'm going to lecture here for about 30 minutes, and then I'm going to ask if there's questions. And if there aren't a lot of questions, I'm just going to continue, because I probably have more material here than I can get through. But that's just how we'll do it, and I'll ask questions. So if you have any questions, please write them down, And in about 20 minutes, we'll open it up for questions. So is market profile a standalone method? And the answer is, well, some people think it is. And so let me take a minute here and put a profile chart up here. This is a profile chart. And what it does is it shows us a value area high and a value area low and a point of control. Now, when you look at the point of control, this goes back to yesterday's profile. Yeah. So yesterday's price action was this profile right here. And the thickest part of the profile, the thickest part, you can see that it sticks out right there, ends up being what's called the point of control. That's the very thickest point that you could find, or you could call that the point that touches the most bars. So you can see that it's right there at the bottom of that bar right there, and then these bars here. That's called the point of control. And then this value area high and value area low are basically one statistical, that's why I said if you took like a statistics 101 class, these are 68% of the data. So 68% of the data inside of this yesterday's price action is encompassed inside of this value area high and value area low. Yeah. Inside of this value area high and value area low. Now, you can also see, and I find this to be very good if you're using profiles, to always make sure that you take a look at how wide is that profile actually. And we're going to touch on that a little bit more in a few minutes. This is like 35 ticks, and take the 77 minus the 36, and that's a pretty small distance. That's a pretty small distance. And so on some days it'll be much wider, and so there's much more to play with. So it's important to know on a day when the profile is narrow that you may have yourself in a breakout mode like what we did earlier today. And then you get what's called a multimodal profile, where the bulk of it ends up being down in here. And this hasn't actually, this profile right here will end up being tomorrow's profile, just like this one here. So that's the basic thing of the profile, is that you're turning a bell curve distribution on its side and laying it over price. Now, one might ask the question whether or not a regular statistical distribution like a bell curve distribution is representative of how a financial market actually works. And that's an important question to ask, because the way a bell curve distribution works is if you had a whole bunch of grains of sand and just kept dropping them from the exact same point over time, eventually you would get a mound there, and it would make a nice curve going down on each side as the grains of sand hit the top of the pile and rolled off each side, and would make a nice shape. But financial markets actually don't work that way. Financial markets actually become skewed, like what happened here today, as it broke out of this profile region for today. And so it's actually pretty normal to actually break out of that. And so you have a couple of different modes of operation with a profile, where you're asking yourself the question whether or not they will be able to defend it, You can see from earlier on in the middle of the night, it went from the value area low to the value area high, and then it went from the value area high to the value area low just before the open this morning, and then it went from the value area low to the value area high, and then it went back from the value area high to the value area low. That's not actually particularly normal to crisscross that thing like 5 times. But when it finally came out the other end, what happens is this group of traders that are profile traders will end up getting stopped out over in here, and their stop orders will propel the market into ranges outside of that. And so that's what happened today. So is market profile a standalone method was the question that I had asked. And the answer is it can be. But what do I use market profile for? Is I use it as part of a bigger picture. I have many different things that I use, and the market profile is one of them, because market profile has a wide following. And so I strongly advise in your trading that you have an idea of where these folks are, because you will see, as we just saw in that chart, that the market will interact pretty much right on the money where these people are trading at. So if you don't know where those levels are, you want to make sure you're not trading, firing a trade short right into these people, because they're going to fade right into you. So fundamentally, market profile players are counter trend players, but particularly so when you open up inside of the value area, between the value area low and the value area high. So I'll give you a couple of statistics about that just off the top of my head here. And that is, if you open inside of the value area, which is inside here, which is what we did today at 6 o'clock, this particular market, this crude oil market, opened up right here. And so when we open up inside there, I know that the profilers, these folks, for each side of this, are the ones that are in control. The profilers are in control, and they will tend to fade these extremes as you get there. So you want to make sure if you're trading on a chart like this, that when you get down in here, hitting that profile, you want to make sure that you don't get on the wrong side of them, because they're a powerful group. So if you open inside that value, by the end of the day, there's a 33% chance that you will finish the day inside, a 33% chance you'll finish it above, and a 33% chance you'll finish it below, which is random. It's 33, 33, 33. And so when you open inside a value, so just a good one to know there. So I would definitely make a note of that. If you open inside a value, expect to finish on either side of value or inside of value. But if I open below value, I will expect to finish below value. Or if I open above value, I will expect to finish the day above value at about the 78% level. About 78%. So open inside, 33, 33, 33. Open below, 78% close below, 78% close above if you opened above. So hopefully that's helpful to you. And so I use market profile for the big picture. I use it in conjunction with other things because its relevancy changes depending on the situation. Its relevancy changes depending on the situation. I also want to know, as I alluded to, when the market profilers are in trouble, because they can really propel the market, as we saw on that chart earlier. Now, I can't prove that it was the profilers that did that, but I've been watching this every day for 15 years now or so, and it's actually works pretty well. So market profile works. This is my own opinion on it. Market profile works because there's a large following of traders that are doing it. More than it is a statistically valid method, because it's 33, 33, 33. It's actually a random distribution. It's based on a bell curve, which is a random distribution. And so you want to know when these different situations are that I'm describing, so that you know what happens when these folks get themselves in trouble, or they're going into one of their trade levels, the value area high, value area low, and point of control. So now what we're discussing also applies to different market profile derivatives like volume profiling ladders that we discussed earlier. But as you get more away from this group of traders, what happens is you're no longer following specific people. And I find it very useful to know when there are specific people that are trading on a chart, and when I can see them specifically interacting with those exact levels. It's a beautiful thing to be able to see, and we see it every day. So in other words, market profile works because there are people that are following it more than it works because it's predictive. So for that reason, we convert what we know about market profile into people so that we can make actionable things about it. Now, I had already discussed the value area high, value area low, point of control. And and we already discussed what those levels are. And we discussed the fact that they are actually random at their core, which is another word, normal is another word for random. But that doesn't make it unusable. Actually, it's quite usable, but you have to take it contextually. Now, I'd already discussed the skewing a little bit, how markets naturally distribute is that because almost every single day, the profile is not going to be the expected range for the market, which means at some point or another on almost every single day, on most days, the profilers get into trouble. Yeah. And so what we try to do is interpret where they're going to be into trouble approximately and trade for that blow off or that skewing where it's no longer evenly distributed. Yeah. And so what we're doing is with this sort of thing is we're going from the middle. We're looking at the way that it's working from the middle out. Yeah. The middle out, or from normal to abnormal. We're trying to trade from a normal situation into an abnormal situation rather than trading from an abnormal situation back to a normal one. Yeah. So what makes market profile important? Well, who's using it? And a ton of people using it. Now, it's interesting to note that, like, you know, you talk to people that trade in stocks and things like that, they really don't know these things. This is a future market specific, although I think it's starting to grow outside of that. Yeah. So I already discussed converting the market profile into people so that we can understand it better. So if you trade on market profile and you convert market profile into people, then you fundamentally understand things about how people feel when they get into different situations with a market profile. And that's when you do that, you can teach yourself. Yeah. Yeah. Now, there's a certain thing like on that profile that I showed you earlier. This morning, we shot through the value area high a little bit, and then it becomes this questionable thing whether or not they're going to be able to continue that. But when it starts coming back down inside, back to the value area high, that becomes an invitation to this group to drive it back to the other side again, which is exactly what they did. Yeah. So if I'm up here trading long as a trend trader, for example, and I see that bar comes in there and it's not, that bar doesn't get enough of expression, it ends up being a really small bar. You should be getting a bigger bar there. And then it comes back inside. All these things together tell me that these guys are in control again as it goes here, and they take it coast to coast, and then it just doesn't look back and just keeps on going. Yeah. It's a beautiful thing. To see it happen live. Yeah. So I'd already mentioned how wide is the value area. When the value area is narrow, it means that the prior day was much more normally distributed or bell curve-ish than it was before. And that generally puts you into a breakout mode. Yeah, as we discussed earlier. So when the profile is narrow, watch for these guys to get into trouble a little bit easier than they would otherwise. So now another one that happens is on some days you're going to open like right on that number, or like within 5 ticks of the value area high or the value area low. That is a really dangerous thing because when you open right there, it becomes ambiguous. Remember we said if you open above value, you close above value, you open below value, you close below value, open inside 33, 33, 33. Well, when you open right on the number, these guys don't know what to do or they become mixed. So anytime you open right on a value number, be careful. Be careful. Yeah, you got to get some more information before you start jumping on the bandwagon. You don't want to get on the wrong side of a random bunch of random traders. Yeah. So you want to make sure this group is on your side, in other words, and knowing when they're in trouble. Yeah. So hopefully that's helpful for you. Now, on any given day, the market profile might be, I don't know, just off the top of my head. So let me show you another one that I have here. So this level right here is the initial balance period level, the 2 white lines right there. Yeah, that's the first. I have this set to the first 2 periods of the day, the first hour of the day. Yeah. Now, this level right here is half of that, again higher. Yeah. And then this one is half again higher again. We call these the initial balance period multiples, which I mentioned earlier. And the probability of going to this first multiple of that is about 79%, somewhere in there. Yeah, about 79%. And the probability of going to the second one is actually about 50%. Yeah, about 50%. So that's why profilers watch that first hour of trading and see which side it breaks. Yeah, because once it breaks that side, you tend to go to that other one at about 80%. Well, that's good to know. Is that a trading system? Could be if you want it to, but we got better technology than that. But generally, that's the theme that's playing out, or the general idea that you're working with there. Okay, so, and we call this the textbook market profile play. If you open outside of value and you come back and touch the value area, you open outside of value either above or below, then the market tends to come back to the value, or it doesn't, it's random for it to come back, but if it does come back, these guys will fade it and they'll become trend players. Yeah, they'll become trend players, trading away from the value area. So you open above, you come back and touch, you fade it. If you open below, you come back and touch, you fade it. Yeah, so that's a good one to know. Why is it important to set up your market profile to what others are using? Now, this is an important topic. I had mentioned using time at price, which was the original method that they developed, because that's probably the most followed one. Yeah, and so it's also important to set it up on 30-minute charts, as I had alluded to. Yeah, yeah. And then as you interact with the profile, you convert it and you're asking yourself as you're using it, how would I feel if I was those people right now? Or and as you get more advanced with that kind of thing, you can ask yourself, well, how would I feel if a certain thing in the future were to happen? Yeah, and that way, when you start thinking that way as a trader, you're actually thinking predictively, and you're also thinking conditionally. And as I said, watching the interactions at any of these key levels, super cool. I think you'll like it if you try it. Yeah, I'd mentioned if we open at or about the value area high or the value area low, yeah, be very, very careful at those levels. Market profile shapes. I said if you have a narrow profile, you're going to tend to have what's called a D-shaped profile. Yeah, a D-shaped profile. And when you have a D-shaped profile, generally speaking, you're in some kind of anticipation of a breakout mode, because the market's not going to stay inside of the value area all day long. Yeah, yeah. And so you'll see how the market will make its extreme. So you open today inside the value, right here at about 6 o'clock. Yeah, we open right in the middle of it pretty much. Yeah, and then it does, it goes up, it comes back down, it goes coast to coast, keeps on going. Yeah, and then you end up with a profile here that's actually more B-shaped. It's shaped more like a B. Yeah, or you could have a P-shaped if it had done it going up. And the other note that I had there is whether or not it's important, the order that it happens. Yeah, and so if you notice that the extreme happens later, yeah, that's different than the extreme making the extension earlier. Yeah, and so that's something worth thinking about. Yeah, and we'd already covered where you open compared to where you close. Yeah, if you open out of value, 80%, 78%, somewhere in there. Yeah, we covered the initial balance metrics and the probabilities associated with them. That a half multiple of the first hour's trading is about 79, 80% to hit that every single day. Yeah, and then to go to the second one, the second multiple that we just covered on the chart there, it's about 50%. Now that's really interesting for me, because when I look at that, I go, okay, going to there is 80%, but going to right there, or if I was going up, going to right there is 80%, but going to right there is 50%. So between right there and right there, I go from 80% to 50%. Well, I'll split that in the middle. I go say, well, is that 68%? That's going to go up in there or something like that. Yeah, so interesting stuff, I think. Yeah, so and we covered the initial balance metrics. Yeah. Okay, let's see what else we've got. Market profile, the numbers. We've covered all the different statistics associated with that. Yeah, and those are just good things to know when you're trading on a market profile. Yeah. What are other important things to know about market profile and the 30-minute metrics and things like that is that the market profile is based on a distribution, but the the fact is, on most days it breaks out. Yeah, we already talked about that. And so how consistent is market profile as a standalone system on the end of any day? Well, it's kind of random. Yeah, but it's not random when you consider the things that we've been discussing. So you want to watch for those interactions with the different levels. Yeah, and thinking of them as parties. Now, I could go on to some other things here, but I promised that we would cover any questions. Let me see if I can find my chat and see if you have any questions, please ask them. And if not, I will just keep rocking here. I have more to share. Yeah. Yes, I don't see any questions here. I'll keep my chat where I can see it, and I will just continue with the concepts here. Yeah. So what is an anomaly? An anomaly is an interesting thing. One of the first guys I ever had in my trading room was a market profile guy, and I learned a real lot from him. And he taught me that this thing called anomalies. An anomaly is when two 30-minute periods leave a gap in between them. So if I have a 30-minute period right there, and then I have another 30-minute period right there, and then that period opens up right there, and it leaves a space in between them, that's what we call an anomaly. Now, the cool thing about anomalies is that the market doesn't like leaving them there. Now, what's another name for that in auction market theory parlance is called a single print. So on the profile right here, you see that's a single print. It's the narrowest point right in there. And just that bar is there all by itself. Now, I've learned all kinds of interesting things about how the bars distribute, but generally speaking, I expect on any given day, about 80% of the time or better, that this is going to get closed up. This is going to get closed up most days. Yeah. So on any given day, you might leave one. Yeah, you might leave one. And so a better part of a day's expression happens due to one of these being left behind. And so that's a very cool thing. Now, there's two ways that you can have a intrabar. You can have an interbar anomaly. Let me see if we find one here. Yeah, if this F period here takes out that prior period by 15 ticks or more intra-period, and it starts coming back the other way, it'll tend to close it. It'll tend to close it. Yeah. If this comes up here more than 15 ticks and starts coming back the other way, it'll tend to close it and not leave that big gap there. Yeah. That's an intrabar anomaly. Now, those can be a little hard to see. I find people that are super smart can sometimes have difficulty with that. But the trick is to learn to be able to see a space between two bars. If you start there, you'll be able to get it pretty well. Yeah. Okay, so we covered that, intrabar anomalies and anomalies. Super cool thing to be able to be aware of. Yeah, because the markets definitely distribute themselves around these things. And that relates to 30-minute overlap. And I use the term here underlap, or I could call it overlap and extension, yeah, related to the market profile. Yeah. And so that concept is pretty cool. What are the shortcomings of the market profile? Well, it depends on how you look at it. Yeah, we were describing that earlier. If I look at it contextually and I look at it as people, then I can get on the right side of it. But if I just trade it blindly, like, okay, if I approach the value area high from above, I fade it. If I approach the value area low from below, I fade it. If I open inside, I'm trading to the market profile extremes. By the way, those numbers are extremely high to hit those. Yeah, if you open inside a value, extremely high probability that you're going to hit the value area extreme. And then secondly, usually it goes off in this sequence. Number one, hit value area extreme. Number two, hit overnight high, overnight low. Number three, hit prior day's range extreme. When you open inside, boom, boom, boom. That's the first three things that you want to be thinking in your mind. Yeah, in your mind. Yeah. So what else we got here, guys? What's more normally distributed than a market profile? Ooh, that's interesting. Let me see if I can find an example of this for you. There's a thing here that I've been teaching for years and years and years called probability inversion. Probability inversion. Let me just put that table up there. Probability inversion. This is this kind of thinking started with some studies. I hired a programmer years ago to do all these distributions for me. But this basic one, because it also works with ABC cycling, but that's a little beyond the scope of what we're discussing today. When a bar chart using a Smart Super Renko set to 515 bars, I'm going to show you that in just a second, goes to 20 ticks it does a reversal and then it goes to 20 ticks. 68% says that it's going to get a reversal bar. Yeah, 68% says it's going to get a reversal bar. Once you go 25 ticks past, yeah, once you go 25 ticks, it's about random. And once you go to 30 ticks, it's about 29%. In other words, 70% says it's coming back the other way. By the time you go to 35 ticks, about 80% says you go the other way. By the time you get to 40 ticks, about all close to 90% says you're going to go the other way. This is on its own without regard to anything else. Yeah, so let me show you what that looks like. This is super cool stuff, guys. Or at least I just love this kind of stuff. Yeah. So this is a Smart Super Renko chart. Smart Super Renko chart. Let me open this guy up a little bit. Yeah. If I go here and I go two more, yeah, about 68% says I'm going to what? Get a reversal. Yeah. I go here and I get two more, about 68% says I'm going to get a reversal. Yeah. Here I go reversal plus 1, 2, 3, 4, 5, 6. Yeah. What's the probability of getting a reversal? More than 90% of getting a reversal right there. Yeah. I go 1, 2, 3. Now if I go 3, about 70% says I'm going to get a reversal. Yeah. Yeah. So it's actually mapping out what's the probability. So if I go R1, 2, 3, 4, 5, 6, 7, 8, 9, the probability of getting a reversal there is 99%. Yeah, 99%. So again, this is called probability inversion. If you're watching the video, you can take a screenshot of it. And this is at the basis of some what we call market mapping, and just looking at how the market distributes itself so you get a baseline. But what I found to be really fascinating about this when I did it was just exactly how perfectly distributed it is up and down over large amounts of data, huge amounts of data, that the market just keeps playing these scripts over and over and over again. And I called this, again, probability inversion. Yeah, probability inversion. So hopefully that's useful to you. Now, when markets really take off, they don't do that. Yeah, that's where you get the skewing. Yeah, that's where you get the skewing. Yeah, so that's the notion of probability inversion. And then the other one that I said was the ABC cycling. We could take a minute and cover that. I don't want to go past. Yeah, we got about 7 minutes remaining. ABC cycling, that's just where the market's doing exactly what we're seeing. It's going up and down. And we've developed a whole technology around that that's a little beyond our scope here today. But I just wanted to mention that this also has a perfect statistical distribution, just like a market profile. So both of these things, in addition to market profile, are based on natural distributions, and it works over and over and over again. It's just crazy, amazing. Yeah. So why market profile? Well, because there's lots of people following it. And we've talked about a lot of different ways of where and when it might work best, and how you can know, and being aware of the counterparties and being aware of it as people. Yeah, being aware of it as people. And that just kind of, that's putting it all together. So in today's video, in today's webinar, we used the smart volume profile, and we used the smart, actually, I didn't use the smart periods. Let me show you the smart periods here for a minute, because these boxes, I meant to tell you this earlier, but I just kind of overlooked it. These boxes are actually these 30-minute bars on this other chart here. So what we do is we map these 30-minute bars, like right onto these smart Super Renko bars, and it gives us tells us what the statistics are for what it's doing. Yeah, and so this is a super useful way of kind of keeping track of it, where you can actually just glance up there and see it tells you what the range is doing, which way it's extending off of the open, and where it's closing. And we've developed a whole technology around this kind of stuff. Yeah, so. In today's webinar, we've used the Smart Volume Profile and we actually used it in the time price mode. So we used it in a market profile mode and not a volume profile mode. And that is my personal choice because why? Because I know a lot of people are following that. Yeah. And the reason I know a lot of people are following it is because when we hit those numbers, we turn like right on them, pretty crazy. And we use the smart periods and the smart super Renko to map those 30-minute bars. Because why? Because the 30-minute time frame is the dominant time frame. Other related indicators would be the smart support resistance. Actually, those initial balance periods that we covered here, these levels come off of the smart support resistance tool. That can be very useful for keeping track of that for you automatically. Yeah. So that's what I have for you today. This is kind of like a rapid deep dive of market profile and all the different ideas associated with it. Of course, if learning to trade market profile in the kind of ways that we're talking about and knowing when profilers are in trouble or not, when they could help carry your trades to success, we do those things in the trading room each day. Where I cover these kinds of things in more detail. Yeah, so if you're interested in learning more, you do the trading room. Also, let me see here, resource where you can learn more about these kinds of things and others that I've offered over the years, IndicatorSmart.com, and the indicators that we use today can be found there. Of note, you may choose to review that first page there. It talks about the 4 quadrants method for building trading systems. It's based on strong, solid concepts, and also market mapping and the trading rooms and probability inversion and all those kinds of things. You can learn more about that there. And also, I promised today I'm going to give you a code that can be used for discount at any of the trading room sites or IndicatorSmart, a real nice coupon code that will be good until Sunday night. I prefer, if you're thinking about something, if you can, to get it in before Friday, because I don't work on the weekends. Yeah, so I don't work on the weekends. So, all right, guys, we got about a minute and a half remaining. If there's a question, throw it in the chat there. Other than that, I'd like to thank you for giving me the opportunity to share what I'm passionate about with you today. We've got a lot more to offer. We've developed whole trading technologies that we share through the trading rooms and through the website there, IndicatorSmart.com. I would like to thank NinjaTrader for having me. I'd like to thank Patrick for putting this together. Yeah, thank you, Patrick. And that's what I got for you today, guys. Yeah, thank you, and hope to see you again on the next one.
Hey, thank you, Rob. Appreciate that. Thanks for joining us.
Thank you.
All right, switching over to my screen here. Just a quick few notes as we end. Once again, want to thank Rob for taking the time to share that information with us today. Everyone in attendance will receive an on-demand recording of today's event, so keep an eye out for that email. If you enjoyed today's session, we hope you'll join us for future webinars. You can follow us on social media for alerts about upcoming events and other NinjaTrader ecosystem news. We'd like to remind everyone that the information here today was provided, as it was provided, is that of IndicatorSmart.com and not of NinjaTrader. All information was for educational purposes and should be not construed as trading advice. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us here at NinjaTrader Ecosystem.